My name is Anthony Fatsis, and welcome to the WTFinance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again, and I hope you enjoy. So, Ed, thank you so much for joining the WTFinance podcast to talk about your upcoming book, The World's Simplest Stock Picking Strategy, which is available for pre-order at the moment on Amazon and is officially released, I think, on the 16th of November. So
Yep.
just on to my first question. What was your influence for writing the book?
Yeah, sure. Well, first, thanks for having me, Anthony. It's good to be here. So the book it describes the strategy that I use myself to invest in my personal account. So I didn't really set out to be an author or to write a book. I just developed this strategy over the 14, 15 years or so that I've been investing. And, during the COVID period of 2020, I've always gotten inquiries from people, friends and family about stocks and investing, but in 2020, it really picked up. It was noticeable, just the amount of people that were asking me about their new interest in stocks and how they should invest. And I realized that the approach that I was using might be of interest to them. So I decided to type it up into a book. And thanks to Harriman House, we were able to get it published.
Yeah, awesome. And I thought it was quite interesting because, as you said, it's quite simple and it's almost something that anyone can follow. But you're a Wall Street equity advisor, and people might think that your technique would be quite complex and involve lots of data. Can you maybe talk more about that and why it is so simple?
Yeah, sure. So I really developed. I first worked in trading where I was trading commodities and stocks on a short-term basis, based mostly on technical analysis, a little bit of fundamental analysis, but a lot on technical and price and volume flow and that sort of thing. Then I got into the equity research side of the business where it's more fundamental, valuation based, financial analysis based. But in my personal account, I got frustrated watching these companies that were so obvious to me as a consumer just keep racing to new highs while I was off trying to, discover the next undiscovered value stock. So I kind of developed this for myself as a blueprint that would help me to catch the next home run stock that in hindsight was going to be obvious to everybody. The Amazons, Facebooks, Netflix, those type of stocks that have been incredible winners, but to most people, they're only obvious in hindsight, where they don't really have to be. I mean, a lot of people who are sitting outside the Apple store every day in the rain and cold for the new product. So that product was clearly important to them, which would indicate that Apple had exceptional and special pricing power and might have the ability to drive earnings over market cycles and over time. But they probably didn't think to invest in the stock. So, you said you read the book. The crux of it is just keeping a list that you update every 3 months, where you keep yourself aware of the new products and services that you're using, the companies that are in your life, and it'll just it'll be an alert to when a special company enters your life, which could end up being a special stock too.
Yeah, and I think that's, if you look at the past 10 years, the people who have been the most successful, the ones who, as you said, invested in those massive companies, being quite passive, whereas sometimes people like to overcomplicate things and they like to look for the really undervalued stock that should boost up rather than just going for that stock that, as you said, is just going to grow and that you're already using every single day.
Right. And, one thing working in the industry, like when I was younger and newer to the industry, I just assumed that those stocks were too obvious to make a lot of money in. But then if you look at the holdings, and they're publicly listed, of like the major mutual funds and money managers, some of their biggest position are in these companies that to consumers are obvious. The Home Depots, Costco's, Amazons of the world. And there's a reason for that. It's because, stocks seem like these complex financial instruments, but in the end, it comes down to earnings and pricing power. And these are the companies that are resonating with consumers, and they have pricing power and they have loyal, sticky followers. And so they make for good stocks over long periods of time. They may, in any given year, they may underperform the benchmark. And that's why I suggest for non-professionals, you leave that game to the pros. You don't have to compete against the benchmark every year. But yeah, I think for the non-professional investor, focusing on the special companies in their life and taking a long-term approach can yield some good results.
Yeah,
That's for me. And that's another thing I would just mention for myself. I found that I was able to invest bigger sums of money with this approach than I was when I was trading based on either valuation or some financial analysis or some macro bet that I was making on the future, or some other person's idea that I read about. In those cases, like, I would get interested in a stock and I would bet a small amount. And I had some good ones, I had some bad ones, but in the end, it's not all that meaningful. It's not going to be enough to get a down payment on a house one day or retire early or that sort of thing. I found, though, that when I switched over to this approach, I have to make big gains in the stock market. You need to be able to take big gains. You need to be able to maintain big positions in single stocks. And to me, I find for myself that I have more confidence taking big positions using this approach.
Yeah, and it just makes sense because you're actually backing companies that you like and that you enjoy, and that at least within the next 3 months they should be okay. And then if something changes, then you can, that's a part of the system. If something changes, then you can maybe downgrade them or change it up and get out of it.
Right. And I think having a system in place is important because it sounds easy to invest in the companies that and use, but a lot of people lose money doing it that way. The market, a lot of it is just psychology and not bailing at the bottoms and just having confidence in adding to positions when they go down. And that's where I think having a system in place is kind of critical. I used to, in the early days of when I was practicing this, I would just buy the whole way up. All my savings I would pour in, and I just found a lot of times then the market would correct and I would be kind of waiting it out. I'd be nervous and anxious, and maybe I invested too much or got too aggressive, and I was basically riding out those tough periods, hoping for it to rebound. And just seems the way it always ends up seeming to work is that you added the most money at the top. And then sometimes you either think about bailing at the bottom or you don't have the confidence to add more because it's scary during those periods. But, like I talk about in the book with recommendation, number one, buying on pullbacks, like I kind of have switched the investor psychology there, where now I'm actually waiting for pullbacks because I'm accumulating cash each month while the market's not oversold. And, when those corrections do happen, I'm kind of like getting an itchy trigger finger. Like I can't, wait until it actually hits my oversold benchmark, my oversold thresholds, that I can start putting some money to work in these companies that I want to invest in. So it's just flipped the whole psychology around, and I've found that to be very helpful.
Yeah, definitely. And obviously the majority, you mentioned that you put in these stocks that that are that you use every day. And then you also have a little bit in the passive income like ETFs and indexes. Do you have any that you actively trade as well? Or is it mainly just those two methods?
I have given up the short-term trading. I was pretty obsessed with it for 4, 5, 6 years there early in my career. And I had some success with it, but the short-term trading it requires constant attention. There's a lot of anxiety too. We were waking up in the middle of the night checking positions, and you can have a good run at it. And some people are successful at it over long periods of time, and hats off to them. They make the big bucks for it. But I just felt after 5, 6 years, I wanted to switch to just the long-term investing. And I think it's better for my long-term returns and for my overall mental well-being as well. Because the short-term stuff, it's tough to stay on top of it. It's it's a full-time job to do it right. And it really comes down to risk management in the end. Because even some of the best stock pickers out there, their ratio is only going to be a little over, their hit ratio is only going to be a little over 50%. It comes down to really keeping an eye on it and letting your winners ride and cutting your losers. And it's a tough job, I think, for the average non-professional investor who has an interest in stocks. The long-term investing route is the better approach.
Yeah, and you mentioned there it brings like it very much brings your emotions into it, especially when it's short term.
For sure,
Trying to
for sure.
control them and stick to your strategy when things aren't going your way.
When you're focused on the short term, identifying a super special company like a Google or an Apple or an Amazon doesn't mean all that much. It comes down more to price action and volume flows and reactions to earnings and that sort of thing. So which are it's very tough to trade based on that stuff, just because the market is very efficient. Stocks they incorporate new information almost seconds after an earnings print. So it's tough to get an edge on that. And so like when I see people in my friends and family who take an interest in stocks, which I think is great. During the COVID period, I told you, like, I had a lot of people reach out to me with an interest in stocks, and one of them was my godson, who's 19 years old. And I thought that was great that he was taking an interest in stocks and companies at that early of an age, but I felt that he was getting pulled towards the meme stock route, which just, that could end badly. And that's for him, he's not looking to become a professional investor, so he's not going to be attracted to value investing or doing real financial analysis. And he's also got an interest in stocks, so he doesn't want to just invest in ETFs. So that's where I feel like my approach would be perfect for him, because he can embrace his interest in stocks and he can take a somewhat active role in picking stocks. But if at 19, 20 years old, he starts investing in some of the most special companies in his life, if he ends up catching some of those stocks and riding them for 20, 30-year waves, it could actually make a big difference, down the road for him.
Yeah, and I guess you could say it's a lot of young people are very impatient. They see a lot of the people flashing their wealth online or supposed wealth, and they might want to have that straight away. And I guess that's a challenge for a lot of investment educators as well.
I think it is. And I feel like I kind of went through this natural progression 10, 12 years ago, where I was first drawn to the short-term trading because that's where all the action is, and trying to beat the market every day, week, month. But I think then a lot of people, that interest in stocks and in businesses, it might not go away, but at some point you're gonna, a lot of these people who are trading stocks, when they start to see losses, may give up on it. But that doesn't mean they have to give up on stocks and investing completely, and they shouldn't. So, I mean, this I feel is a good alternative approach for them, where they can then shift to a longer term, longer term approach to investing.
Yeah, definitely. And you explained a little bit before about the process and how it works. And, maybe without giving too much away, can you go more into the strategy and sort of how you analyze your own life as a consumer, and then sort of pick these stocks from there?
Yeah, sure. So to me, it comes down to, you keep a running list of the companies in your life, because that's how you keep tabs of everything you're using. A lot of people aren't even aware of some of the great companies that they're using every day, sometimes, or weekly or monthly. So first off is just taking inventory of everything you use. I found that to be extremely helpful when I first started down this path. And then the second is, you're going to find that you use a lot of companies. You can't invest in all of them. So you want to focus on the ones that are most special, because special companies that have a product or service it's not easily replaceable, or you would miss it greatly if it went away. Or, one of the things I ask myself is, how long do I think I'll be using this company or this product or service into the future? If the answer is, this company, this product or service is not really replaceable for me, I love it, I would really miss it if it went away, and I think I'm going to be using it the rest of my life, that's the type of special company I want to focus my capital on. If you answer those, if that's how you think about a product or service, there's a good chance that that company has significant pricing power, and over a long period, you're likely not the only person who feels that way about the product or service, and you're probably not the last person who's going to feel that way about it. So to me, that would indicate a company with exceptional pricing power that could generate powerful earnings at some point, either now or and into the future through market cycles. And those are, that's the recipe for a great stock. So when I do that personally, I find that my list of companies that I use gets down to, it's going to fluctuate for each person, but mine is between 10 to 20 stocks that kind of fit that bill. And that makes for a good amount for a concentrated but diversified portfolio. And then, as I mentioned, in the recommendation, that you put $1 into an ETF for every dollar that you do invest in an individual stock. That's what the recognition that stock picking is difficult. And, you don't want to be sitting there 10, 20 years later where you poured a lot of money into stocks and the stock market as a whole kept marching to new highs, but you were sitting on losers because of your individual stock pick. So to hedge against that scenario, that's where I put $1 into an ETF for every dollar I put into an individual stock.
Yeah, and it's a good balance, as you said. Like, it's always, if you look at these ETFs, it's mainly like 4 or 5 or potentially 10 companies that are really carrying the ETFs, isn't it? The majority of the other one, like you look at the S&P 500, the majority of other stocks might drop out. But so I guess it's, as you said, it's balancing your risk. So you're taking some bets, but then at the same time you're also covering yourself.
Yep, exactly. And it's just, it comes down, if you have no interest in stocks or stock picking, an all ETF strategy is perfectly sound advice. You can just put a portion of your paycheck into an ETF every month or into Betterment or one of these robo advisors, and that's perfectly fine, and it works for a lot of people. But if you have an interest in stocks and want to attempt to outperform, and you want to invest in individual stocks, I think like the process that I've settled on could be useful. And since it's really based on investing in what you know and what you use, it really anybody could execute it, is the way I feel about it. It doesn't require financial analysis or discovering the next value stock or learning how to manage stops and stop losses and all that sort of thing. So I do feel like this strategy is something that anybody could pull off. I see it with my wife. She has never had an interest in investing, but when I talk to her about this, and like now she's like an unbelievable stock picker. So if she had been doing this all along, I'm sure she would have beat me.
Yeah, I think you mentioned Etsy is one of the companies that she loves and you love as well, and it's done quite well over the past year or so, hasn't it?
Yeah, it's had a good run over the last year or so. That's I'm taking a longer term view of that. So I mean, the market's had a great run too. It's just but yeah, that's a stock that's kind of newer on our radar and seems like it might be one of these special ones to us. So yeah, I highlight that one in the book, and still is. So we'll see if the market gets oversold at some point, or when it gets oversold at some point on that technical indicator I talk about in the book, then I would probably look to add more.
Yeah, definitely. And I guess you could say the one issue is that you're not really looking at the macroeconomic environment. So, we've seen maybe increase of volatility over the past year, uncertainty due to inflation and COVID and sort of other shocks. So do you think this will have an impact on it? Or do you just think that because it's so long in the future, it's not really something that's, will impact the strategy?
It won't impact the strategy. I don't take macro bets anymore. I used to try to come up with macro forecasts. I had strong opinions on what was going to happen to, interest rates and dollar and stocks and commodities. I don't feel that's a wise approach for a non-professional investor to take. It's, macro bets are often wrong. Even if you get the macro bet right, you might not get the stock picks based on that bet right. I think, when it's better for most people, and I realized I did this, I realized for myself, it's better not to make macro bets. It's just, for me, I focus on the stocks that are special. When the market pulls back and reaches that oversold threshold on the indicator I talk about, I add to them. If the market is not oversold, but a new company enters my life that seems like it's one of these special companies that I could own for 10, 20 years, I will buy some of it regardless of where the market is. And so I kind of balance my risk in all ways. I'll take a half position even if the market is overbought, just so that, once I won't risk missing the whole move the market keeps marching to new highs. And I ended up actually being early to investing in one of these new companies. But then I wait for the other half, and I wait for the market to get oversold. It's just a way of keeping myself disciplined and keeping that positive psychological balance that I talked about earlier.
Yeah, and I guess if you look over the past 40 years, like there's been quite a few big shocks, but at the end of the day, the market's gone up, especially if you look at the stock market, and that's just the trend, isn't it? And especially when you pick those good companies and the ones that you're interested in, you know, that's what you're
Well,
focusing on.
yeah, that's actually a good point though, that I would mention that I'm still young enough that I'm prepared to execute this strategy through a prolonged bear market of 10 years. I mean, it's possible, it's a little worrying to me that people are starting to accept that markets just go up forever. That does not have to be the case. Like Japanese market peaked out in 89, 90, and it took 30 years to get back to all-time highs. So there's no guarantee that stocks are going to keep marching up in a straight line, and that every correction is going to be bought and quickly rebound to new highs. So I'm very much prepared, and that's part of the reason that I have that recommendation of buying on pullbacks, because I'm prepared to ride this out through a bear market if I need to. And that's what I think you need to be able to do if you're taking a long-term approach to investing. So, the macro, we have easy money right now. The Fed has inflated everything. So yeah, stocks keep marching to all-time highs. So it's been an easy environment to just, buy anything and let it ride and say you're going to buy on pullbacks. But I think if you're taking a long-term approach to stocks, you should have in the back of your mind that you could be in at some point for a prolonged period of a bear market where stocks go down. And in that case, a bear market, you'll see rallies, you'll have bear market rallies. And I don't want to be in a position where I keep buying on the bear market rally because I think it's over. I'd rather just keep buying the dip. And I think I would be in a better mental position to ride it out that way.
Yeah, and I think if you go back to the 70s, like the first half of the 70s was, I think, shocking for markets, and then the second half were really good. So I guess, as you said, it's, even though it hasn't happened now, it's something that could definitely happen. And there's all this talk about stagflation and interest rates and everything like that. And I guess that's the concern. But with your strategy, it doesn't really matter, as you said. It's all about the long term and just holding these companies.
Yep, a 70s type environment is certainly possible at some point where we get a choppy market with low growth and high inflation and a sideways market. But I'm not going to try to predict it. And, you're going to hear an expert on TV predicting it and not predicting it. There's an expert for everything. I think for the average person, it's better off to just focus on what you know, which is special companies. And, that's why I think the investing in what you know philosophy is pretty good, because that's where you can focus and actually build a game plan. You have a frame of reference. You can build a game plan around it. Otherwise, you're just, you're kind of making bets. But so that's why, when you're investing what you know and you kind of create a portfolio off of your life habits, that's when you can just create rules for yourself as when to add to positions, when to sell. And that's what it's one reason why, like, you may sell a position in my strategy just because you stop using the product or service. It doesn't necessarily mean that you're betting that the stock has topped or it's not going to go higher. It's just that if it's left your life, you have no frame of reference on it anymore. And then you're just guessing. And at that point, you'd be better off just putting your money into an ETF, because you're not going to know how to react to price movements.
Yeah, definitely. I think that's a great point. So I would say my next question is is there a risk of maybe becoming overexposed to just your home country? So I guess, it will mainly be companies that you're interacting with yourself, or do you think that's not really an issue for most people?
I think I wouldn't call it a risk. I mean, that's a lot of these big special companies that are taking a part in our life are global corporations. But as part of the reason I use the global ETF, for the dollar that I do put in an ETF, it's a global ETF, and that gives me some global diversification, which I think is important. You don't want to be completely, just invested in your home country. But if you're going to try picking stocks, it's likely that you don't have any edge or any frame of reference on strictly foreign stocks. you're probably going based on somebody else's opinion that you read about, or a macro bet. And so, maybe you think oil's going up, so you you look up the best oil company in a foreign country. But that's not a way that I don't think you have any edge in that. And I don't think you can have confidence putting a big position in on that bet. So yeah, I would try to just get the global diversification through ETF portion of the portfolio.
Yeah, and as you said, I think it's the smartest way to do it because there's so many intricacies involved in, every country, let alone trying to choose from all of them or to invest.
Yeah. Yeah. It's I mean, and I used to try to make macro bets like that. And you could think you could want to hedge against the US dollar. So you buy a foreign stock, and those are all, you can have a well thought out thesis, and if you manage the risk reward right. But then you're acting like a professional in that case. And to me, professionals, when they take big positions in these companies, they do thorough fundamental financial analysis. They meet with the management teams. It's a full-time job for them. They're on top of every news headline. They're coming up with detailed models and estimates into the future, and they're tweaking them for every new piece of information. So, that's how the professionals can invest. But when I see, for myself in my personal account, and for friends and family and other people who want to invest in individual stocks, but they're not professionals and they're not going to do this as a full-time job, I think sticking within the realm of what is the best way to go.
Yeah, I think that's a great point. So you mentioned before when you were younger that you were very into trading and sort of very much into active trading. So when you look back, if you could start your career again, what would you change? Would it be more taking this focus that you are now, this strategy, or would it be something else? Or
I don't think I would change anything as far as what I've done. I mean, you learn something from you take valuable lessons from everything that you've done. So if I didn't go through the many years of short-term trading, I don't think I would have ever thought about markets in this way or come up with this strategy. I I wish I had this strategy when I was 20, 21, because I would have had a good portion of my savings in stocks that ended up being home runs. I caught some of them with a little bit of money, but it's I wish I had this strategy, but no, I don't think I would have done anything differently with my career path.
no, I think that's a great way to look at things. And that way you're not, think, oh, what could have been? What could I have done? But Ed, thank you so much for joining the What the Finance podcast today. Just onto my last question. So sort of what is one message that you like people to take away from our interview and the book?
Yeah, sure. I would say that you could just, if you have an interest in stocks and in businesses, embrace it. And you're going to be told by some people you shouldn't invest in individual stocks, just buy ETFs. You'll be told by some others that, leave it to professionals or learn to be a professional and become a value investor. And I think in that way, that leaves a door open for the meme stock trading and some reckless behavior. And I think if you have an interest in stocks and investing, you can invest in individual stocks. Just get a process in place, focus on what you know, and you could have good results.
Perfect. Yeah. Thanks again. So if anyone wanted to buy a book, I think would Amazon be the best place to pre-order now and then?
Yeah, Amazon. I think it's available at all major bookshops and the Harriman House website as well.
All right, perfect. I'll put that all in the description below, and if anyone's interested, they can buy it there. But Ed, thanks again for the interview.
Sure thing. Thanks for having me.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.